Well, not my fault.
Italian.
I got some questions.
Yeah.
It's bigger than their whole department. You
Same.
run, in a month, you run more calls than you run
Oh, yeah, we
I think we own Shell Lunch.
forgot about that.
It was good experience. I think it's kind of.
You already forgot, we reminded
You
you.
see the bigger picture.
So is it 2 lunches, like you over lunch and I over lunch, or just you and I together are buying for half a lunch?
Because she's like, that means there's more opportunity. She's like, I know where I can go now.
Really pushing the fact that
Equal input.
legitimate international
It's a
kind of
legitimate
event
first international.
that does not count in Canada.
Is one that is 3-year successful. They started a lot of programs.
Okay.
This is one that different.
Yeah. No, it's good. It's beneficial. I'll fill you in.
Perfect.
Yeah. Thanks so much. Good to see you, sir. No joke.
I don't think that's
Hi, Chris. What's going on? How are you? I'm good. Good.
just peanut butter.
Say Ron, that's not a shake. What are you doing? You got your shake?
Tea.
Okay.
You're always just a shake.
So you gonna make all kinds of comments tonight? On what? I don't know. Well, that's usually me.
These are exciting, aren't they?
Because of the peanut gallery? Pack it in here. Try to pack it in there.
Totally. You should bring Director Galen to the show. He does, you know, he said he
On my left.
Ready on the right. If it pleases the group, we will call to order the meeting for the Finance and Audit Committee of the Sacramento Metropolitan Fire District for August 23rd. Do we need a roll call? You can see, huh?
It's up to you.
All right, then. Moving on to public opportunity to discuss matters of public interest within the committee's scope, including items on or not on the agenda. No speakers? Moving on to the consent items.
Mr. Chairman, I'd like to move the consent agenda.
I'll second.
We have a motion and a second to approve the consent agenda. Roll call?
Director Wood,
Aye.
Director Clark,
Aye.
and Director Kelly.
Aye.
Motion passes.
Moving on to our presentation items, we have the financial report through June 30th. Amanda Thomas.
Good evening, directors, Chief Harms. This evening, I will be presenting the financial report for the year ended June 30th, 2018. So that is our fiscal year 2017-18. And while we'll be talking about 12-month numbers, I do want to point out that the numbers that I'll be presenting this evening are preliminary. So none of the normal adjustments that we do as a result of accruals or other audit adjustments would be reflected in these numbers, which means that the final audited numbers that would be presented in our CAFR will be different. But these are the numbers that we're talking about as of June 30th, 2018. So just to start off, we usually look at the district's cash balance, and I'll remind you that this is the balance in all district-held funds. So this isn't just the general fund, but it's all district funds. And you can see that we ended the fiscal year 17-18 with about $71 million balance. That was about $10 million higher than where we ended fiscal year 16-17. And the reason for the increase is that we do have some funds in the IGT fund that are going to be applied to the general fund in fiscal year 18-19. So those were available as of the end of 17-18 and will be used in 18-19. We also have funds accumulating in the pension bond stabilization fund that will be used to pay off those bonds, and we have funds accumulating in the development impact fees fund. So all of that's contributing to an increase in the total cash balance. Turning to look specifically at the general fund, so this chart is showing us our general fund reserves. The blue line represents the fiscal year 17-18 that we just finished, and the red line is the prior fiscal year 16-17. And you can see, looking at the blue line, that we ended the year, and also looking at the table down below, we ended the year with an estimated general fund reserve of about $24.7 million. And looking at that blue line compared to the dashed yellow line, which is where we expected to end the year, you can see that we did end with an improvement compared to budget. So we started looking at that table now. You can see in the first row, 7-1-17, we started with a reserve balance of about $22.4 million, and we ended with the reserve balance of $24.7. Overall, it's an estimated surplus generated during the year of $2.2 million, and that compares to a budgeted deficit of about $1 million. So that's an overall $3.2 million improvement in our estimated results compared to our budget. And I'll talk a little bit about why that is as we move through and talk about revenues and expenses. So this chart is showing the medic cost recovery revenue. The red line is showing the actual results for the year. So for this revenue category, when we say actual, we're talking about the money that was actually collected during the year. And this is a number that does get adjusted based on accruals, but right now we're just looking at the amount actually collected during 17-18. That's the red line. The blue line is what we had budgeted. So we budgeted $35.2 million, and we're looking at an actual number of $33.7 million. So overall, a shortfall of about $1.5 million. You can see that it was an improvement compared to fiscal year 16-17, that green line, but not as much of an improvement as we would have expected based on the rate increases that were enacted. So this is something that we're continuing to look at very closely. Our EMS division is really sort of analyzing some of the reasons why this hasn't been performing as we would have expected, and working with our billing company also to look at some additional measures we might take to help improve cost recovery. This chart shows total revenues. So you can see by looking at the red actual line compared to the blue budget line that despite the fact that our medic cost recovery revenues were about $1.5 million short, overall, we ended up with actual revenues very close to the budgeted number. So actual revenues of about $200.2 million compared to a budget of $200.7 million. And that's largely because we had higher than budgeted property tax revenues. So that was almost enough to offset the shortfall in the medic cost recovery revenues. So this chart, we start to look at expenses, and this is showing just the salaries and benefits expenses. Again, the red line being actual, so we finished the year with $166.3 million in expenses compared to a budget of $167.9 million. So there's about a $1.6 million cost savings there, largely resulting from budgeted but unspent overtime. So our overtime expenses came in less than what was budgeted. And then looking at total expenditures, we had a budget of $201.7 million and actually spent just under $198 million. So that $1.6 million in overtime expenditures combined with about $2.1 million in services and supplies expenses resulted in a savings versus budget in our total expenditures. So looking at a summary of the sort of general fund revenues and expenses for the year, so we're estimating a general fund surplus of $2.2 million. Again, that's before any of the adjustments that will happen as part of the audit process. Our expenditures were under budget, and that resulted from savings in overtime and services and supplies. And then we had a shortfall in our medic cost recovery revenue that was largely offset by higher than expected property taxes. Overall, our unaudited general fund reserves as of June 30, 2018, are estimated at $24.7 million, and that equates to about 12.6% of net budgeted expenditures. So that 12.6% would compare to the minimum reserve target of 15%. So that actually doesn't conclude my presentation, because you might remember this is a chart that we normally talk about in the bi-monthly reports, and this is showing us the SERPed Fund, so that's our OPEB trust fund, and we kind of talk about how that fund is performing, our contributions, and our earnings. And then this is showing that as of the end of fiscal year 17-18, we had almost $35 million in that fund, which was made up of contributions of about $29 million and earnings of about $5.7 million over the life of the fund. But what Director Wood pointed out last time is that we talk about this, but we're not necessarily providing the context of, okay, well, what is this funding? Why are we doing this? Which I think is a good point, which I would like to do tonight to help provide a little bit more context. So what this relates to is our OPEB liabilities, our other post-employment benefits, which is our retiree medical benefit. And that OPEB liability, we had just recently had an actuarial valuation completed on. So I will point out that the valuation is as of June 30th, 2017. So that is a year prior to the chart that we just looked at, but that's the most recent valuation date. We have these done every 2 years. So the next one will be as of June 30, 2019, and it will be done in about 2 years from now. So looking at these overall results, I will just remind you that we have two forms of OPEB liability. There's what's called the explicit liability, and that's showing up in the first column, and that relates to the actual premiums that are paid for retiree health care. So we have a retiree who's receiving medical benefits, and what we pay for that premium, that's what makes up the explicit liability. The implicit liability results from the fact that we have pre-Medicare retirees and active employees in the same risk pool, and we're effectively paying higher premiums for our active employees because we have retirees in the same pool who are paying the same premium, who, all things being equal, would be expected to use more benefits, and if they were in their own pool, they would be paying a higher premium. So the implicit subsidy is the higher premiums that we're paying for active employees because we have retirees in that same pool. The board made a funding decision about 2 years ago when we did the last actuarial study to say, what we're going to pre-fund is that explicit subsidy. The implicit subsidy, which gets paid in the form of active employee premiums, we're not pre-funding. We just budget every year to pay our active employee medical costs, and we're not really going to change that practice. So while we have a liability for the explicit subsidy of $172 million and one for the implicit of $44 million, and those two together are the $216 million, when we talk about pre-funding, we're really talking about that $172 million explicit liability piece. But it's both of those together that make up the total liability. So just kind of summarizing the numbers in that table, our total actuarial accrued liability for OPEB is rounding up about $217 million. That is the liability for retiree medical benefits, so projected benefits that have already been earned by 652 active employees and 699 retirees as of the June 30th, 2017 valuation date. As of that same date, there was $27 million in what's called actuarial value of assets, but think of that as being the balance in the SERPED Fund. So we talked about that being $35 million as of the end of fiscal year 17-18. It was $27 million as of the end of fiscal year 16-17. So when you compare the $217 million liability and the $27 million assets, we had an unfunded liability of $189 million. And that equates to a percent funded of 12.6% when you compare the 217 liability and the 27 million asset. So while that number is relatively low, it is an improvement over the prior valuation date. So we are at 6.2% funded as of the July 1st, 2015 valuation. So the other important piece of the valuation is that it helps us determine how much we need to fund every year. So that's what's shown on this chart, and we're going to focus on the second column, which is the explicit only, because as I just said, our policy is to only pre-fund the explicit, not the explicit and the implicit. So when you look at that column, you'll see that we have a $15 million annual funding requirement, and that's just, as I said, for the explicit subsidy. And that requirement is derived from two components. One is the normal cost, so it's the value of the benefit that is being earned each year, and that's about $5 million. And then the second component is the amortization of the unfunded liability. So think of that like our mortgage payment on what we owe. We're paying that down, and that's about $10 million a year. So it's the sum of those two that determines the total funding requirement. And then how we fund it, so our requirement is $15 million, and we're also making a $15 million contribution, but that gets funded two different ways. So the first is that we actually pay retiree medical premiums, and we get to count those payments toward that requirement. So we pay about $9.6 million in retiree premiums, and then the remaining amount, so the $15 million minus 9.6, is what we deposit to the SERPED Fund to pre-fund benefits that will be paid in the future. So that's $5.4 million. So that's kind of a summary of OPEB, and hopefully helps put that SERPED number in a little bit of context. And that actually does conclude this presentation, so I'd be happy to take any questions on this before we move on to the final budget.
Any questions of our Chief Financial Officer?
I have one.
Go ahead.
Yes,
Thank you, Mr.
Director
Chair.
Wood.
Amanda, it looks like we, from the prior slide, we have $34.8 million in the SERP fund as of 6/30/2018.
Correct.
So that's gone up from the 27 as of 6/30/2015?
2017.
2017. So
Yes.
we've increased, what's that, $7 million in a year?
Yeah, and it's roughly $5 million in contributions and about $2 million in investment earnings over that period of time.
That's outstanding. So that'll bring our percentage down.
Well, our
certainly.
liability will also go up a little bit, but yes, it will bring the percentage down over time, and that's the idea. So we went from, as I said, the 12.6 or the 6.2% to the 12.6%, and we would expect in the next valuation to have a higher percent funded.
That's outstanding. Thank you for that.
And moving on to the final budget, fiscal year 2018, 2019. Once again,
Okay.
Chief Financial Officer Amanda Thomas, please.
Okay, thank you. So now we're just going to kind of move forward. We're moving from 17-18 into 18-19. I'll be presenting the recommended final budget for fiscal year 18-19, and this was really just presented this evening for the committee's benefit and any input you might have before this gets presented to the full board for adoption at the next board meeting on September 13th, I believe. So just as a reminder, a little background, the preliminary budget for fiscal year 18-19 was adopted by the board on June 14th. At that time, we had a balanced general fund budget, essentially equal sources and uses of financing in the general fund. For the final budget that we're recommending, there are some changes relative to the preliminary budget that I will just summarize here. And in the rest of the presentation, I'm really going to be comparing 18-19 to 17-18, not final to preliminary. So this is the only slide where that's the comparison. So overall, we had an increase in revenues in final budget versus preliminary of about $600,000. That's resulting from higher than originally estimated property tax revenues based on the tax roll that was finalized by the assessor. So we sort of estimate what that's going to be at preliminary and final. We actually know what the assessed values are and are able to come up with a much better estimate. So there was an increase there. That was offset somewhat by reducing our budget for medic cost recovery revenues in 18-19, really based on where we ended up in 17-18 and understanding that we kind of needed to ratchet back those revenue assumptions a little bit. On the expenditure side, we're showing an increase relative to preliminary budget of about $300,000. So when you compare the revenue increase to the expenditure increase overall, it's a $300,000 improvement in the general fund budget. And then on top of that, we're starting with a beginning reserve that's about $3.2 million higher than what we thought we were starting with when we had the preliminary budget, because of the fact that we had a budgeted deficit of $1 million in 17-18, but we actually ended up with a $2.2 million surplus. So overall, that's a $3.2 million improvement. So those things all added together mean that we're now, with the final budget, projecting a 12% reserve ratio at the end of the year compared to 10% that we were projecting at preliminary budget. So an improvement of 2%. Okay, so moving on to look at the final budget. This table has a lot of numbers, and it's basically showing a budget summary for all of the funds that we have a budget for. I'm just going to point out some of the high-level numbers for the general fund and a few other things before I move on. So overall in the general fund, we're looking at revenues of about $203 million, expenses of about $204 million, and then we have these transfers that are going out of the general fund, mostly into the capital facilities fund, but we also have smaller transfers going to the lease properties fund and the grants fund. And then those get offset by a transfer that's coming in from the IGT fund. So that overall, when you look at the revenues, expenses, and transfers, we're ending up with a positive change in fund balance, or surplus, of almost $300,000 in the general fund. The other thing that I'll point out on this slide, because I won't touch on it later in the presentation, is that we do have the pension obligation bond fund. So if you'll remember from our preliminary budget discussion, this is the year where one of the pension bond series will be paid off. So we have $25.5 million. That's part of that $71 million cash balance that I talked about in the last presentation. So that money has been set aside for the purpose of paying these bonds off. This is the year when that will happen. So that is budgeted for 18-19, but it is sort of as it says, a special item, kind of a one-time thing that will happen. Okay, so looking a little bit more closely at the general fund, the variance column in these tables, the column all the way to the right, as I mentioned, is going to be comparing the final budget for fiscal year 18-19 to our estimated actual results for fiscal year 17-18. So it's the two shaded columns that are being compared in that variance. And if we look at the blue shaded column, final budget, there you can see that $203 million in revenues, that's about an $8.7 million increase from 17-18 to 18-19. Our labor expenses, $173.6 million budget. That's about a $7.3 million increase from 17-18 to 18-19. Overall total expenses are $204 million, about a $10.7 million increase. And then we have the transfer activity. Overall, I'll basically summarize this by saying a little bit more money coming in, a little bit more money going out. They basically wash each other out. And then down at the bottom, as I mentioned earlier, when you compare the revenue, expense, and transfer activity, we have a $300,000 surplus. This chart I know you're familiar with. It shows the revenue history in the general fund. Obviously, things are continuing to look positive here. So we're in our sixth straight year of property tax increases and our eighth straight year of overall revenue increases. As I mentioned, 18, 19, I didn't actually mention this, 209 million we're showing as total revenue. That's the 203 million of revenues plus the $6 million transfer coming in from the IGT. So this chart basically includes the IGT as revenue, so we kind of have a consistent year-to-year look at total resources. So things continue to look positive. This chart is showing the distribution of revenues. So for 18-19, we expect property taxes to be 71% of total general fund revenues and transfers in, so that this chart also is including the IGT transfer. The next largest category of revenues are our charges for services, so that includes our medic cost recovery, and that's about 23.5%. We have some other smaller categories. Intergovernmental are really property tax related revenues, or redevelopment agency pass-throughs, those sorts of things. That's about 2%. And then we have the IGT transfer in of 6.2 million. That's accounting for 3% of total sources of funds. So total projected revenue of $203 million overall. As I said, that's about a $9 million increase compared to 17-18. That's primarily coming from two sources. So our property taxes are expected to increase by $7 million. That's a 5% year-over-year increase. And then medic cost recovery, we're showing a $2 million increase relative to fiscal year 17-18 actual results. And then the net IGT revenue of $6 million gets added to the 203 for a total of $209 million. Looking at expenditures, labor costs make up about 83% of general fund expenditures. Services and supplies, about 13%, and then we have two smaller categories, taxes, licenses, debt service, and others, a little less than 2%, and then the transfers that are going out, as I mentioned, mostly to the Capital Facilities Fund, that's also another 2%. Looking at the labor budget, it's $174 million, which is about a $7 million increase compared to 17-18. Some of the changes compared to 17-18 are that there was a 2.2% wage increase that was effective July 1st, so the beginning of fiscal year 18-19. There are increases in pension and OPEB costs. We've talked about increasing pension costs as a result of amortization of unfunded liability and the reduction in the discount rate. The OPEB liability did increase somewhat as well, the OPEB contribution did. We did have a reduction in pension bond debt service in 18-19, and that's really because not because of the $25 million payment that I was talking about, but one of the other series of bonds where we have scheduled principal and interest payments. There's just sort of a one-time reduction because of the way that those debt service payments were structured when the bonds were sold. So that's sort of a temporary impact of about $500,000 reduction there. There was the expiration of the SAFER grant, so that was funding 9 firefighter positions. That grant we were able to extend, that it will get us through September and probably a little into October, but the remainder of the year, those positions are funded in the general fund as opposed to in the grant fund. And then the last two that I've listed here basically offset each other, but as a budgeting assumption, we just assume that every approved position is filled, and as a result of that, we have less overtime than we actually experience when there are vacancies, but that reduction in overtime costs gets offset by the higher salaries and benefits costs of more filled positions. Okay, so turning to look at services and supplies, I mentioned that budget totals $27 million. That's a $3 million increase compared to the unaudited results for last year. I've just listed some of the reasons for the increases. They're really relatively small increases across a lot of different categories, but there's increases for dispatch, safety, clothing and supplies, training, insurance premiums, communications equipment, and the ERP system implementation. Those increases are partially offset by reductions in fire equipment supply and vehicle maintenance services that were really due to the fact that we had some large one-time expenditures in 17-18 that we no longer have in 18-19. The final category of expenses in the general fund is the debt service assessments and contributions. That budget totals $3.5 million. That's about a $400,000 increase compared to last year. The largest item in this budget is the $1.8 million assessment that gets paid to the county for property tax administration. That really isn't changing compared to last year, but it does make up for the majority of this category. We also have in 1819 about $800,000 in contributions to other agencies, including there's a one-time cost for a server at dispatch that's in this category. So we would expect that to go down next year as a result of the one-time cost this year. And that's also what's contributing to the $400,000 increase in 1819 versus 1718. And then finally, in this category, we have general fund debt service payments that total about $800,000. So looking at the transfer activity, there's net transfers coming into the general fund of $1.6 million. And that is $4.6 million that's going out to the Capital Facilities Fund, Lease Properties Fund, and Grants Fund, and then $6.2 million that's coming in from the IGT Fund. So looking at the Capital Facilities Fund, we're budgeting for total expenditures in 1819 of about $12.7 million. That's a $5.9 million increase compared to 1718. And then we have total financing sources, so that's money coming into the fund, of about $10.6 million, which is a $3.8 million increase. And what I will point out, you'll probably notice that the 12.7 and the 10.6 don't equal each other, and that's because we started the year with about $2.1 million in beginning balance in the Capital Facilities Fund, and that's because there were items that were budgeted in 1718 that didn't actually get spent in 1718 and have been rebudgeted for 1819, but the funding for those was already in the Capital Facilities Fund, so they're not requiring any additional transfer from the general fund. So we're essentially using a little over $2 million of existing fund balance to fund 1819 expenditures in this fund. So our net funding requirement coming in from the general fund is about $5 million, and that's primarily to fund the debt service payments that are in the Capital Facilities Fund, so from prior year expenditures that we financed. So in addition to those debt service payments, we are budgeting for $8 million in capital outlay. As I mentioned, that does include some rebudgeted purchases for items that were financed in 1718, and those are going to be funded with existing Capital Facilities Fund balance. So some of the major capital purchases for 1819, we have the ERP system implementation, $1.9 million, 2 Type 1 engines, $1 million, 2 water tenders, $0.9 million, 3 ambulances, $0.6 million, and an air rig for $0.6 million. Obviously, there's many other things, but those are some of the major ones that make up the capital outlay budget. Turning now to look at the grants fund. So in the grants fund for fiscal year 1819, we have about $400,000 of revenue and expenditures. Most of that relates to the remaining months of the SAFER grant, which is funding the labor expenditures in the grants fund. And then we also have just the completion of one smaller grant occurring in fiscal year 1819. Obviously, as more grants are awarded, we would amend this budget to reflect that, but this is reflective of everything that's currently awarded. And then the final fund that we're looking at is the Leased Properties Fund. And this is where we account for revenues and expenses for the properties that the district leases. So total revenues in this fund of about $700,000, and you can see that that's an increase of a little over $300,000 from 1718, and that's resulting from the fact that we do expect to have a resumption of lease revenue from the first floor of this building, which is the difference from fiscal year 1718 and contributing to an increase in lease revenue there. And then we expenditures of about $1 million. You can see that that's a reduction in expenditures of about $500,000, and that also relates to the first floor of this building. So there were significant one-time costs that were incurred in 1718. So we're seeing a reduction of expenditures in 1819. Overall, we do still have about a $100,000 transfer that's coming in from the general fund, but you can see that that's a much smaller transfer than what we had in 17-18, so it's about a $500,000 reduction. And then again, like with the Capital Facilities Fund, we did start with an existing fund balance in the Lease Properties Fund of about $240,000 that will be used to fund 18-19 expenditures. That kind of wraps up the discussion of all of the funds, but just to summarize where we're ending up with the general fund, we're projecting a general fund reserve at the end of this fiscal year, so June 30, 2019, of about $25 million. That is about 12% of net budgeted expenditures. Some of the things that are not fully reflected in this budget, but things that we've talked about as we look 5 years out. Pension costs, we know will continue to increase. So we saw an increase in 18-19 versus 17-18. That will continue to be the case over the next 5 years as we see the ramp up in the amortization of the unfunded liability and the full phase-in of the discount rate reduction by CalPERS. Capital replacement and maintenance needs. So we're currently wrapping up a facility condition assessment that's going to tell us what sort of needs that we have at our fire stations. And then we know that we have an SCBA replacement that is not included in the 18-19 budget. And then the future of the IGT program. So that's something that we've talked a lot about. It is a program that has provided significant amounts of funding. So as I mentioned, about $6 million in the 18-19 budget, but it's also a program that has a lot of uncertainty and has had a lot of year-to-year volatility. So I think that the practice that we've moved towards of essentially having a one-year lag from when the IGT revenue is received to when it is used as a general fund resource, I think has been stabilizing. That's probably something that we should continue to do and maybe think about this funding source in the future contributing more to one-time needs as opposed to relying on it as an ongoing source of general fund revenue. And that does conclude my presentation, but I'm happy to take any questions.
No questions? Well, certainly the items that we are tracking, like you said, the SCBA and facilities, will eat up that money in a heartbeat. Next year's and the year following, probably. Thank you very much for that presentation. No questions from the group. Thank you again.
Director Kelly, could I just have just a couple comments real quick?
Certainly, please.
First off, thank you to Amanda and Ron and their group in finance for the work that they put in on just last year's budget and pulling everything together, and then this year's budget and giving us certain direction as we started into it. But as she said in it, and you look at that there, we're essentially starting at about a balanced budget, taking those 9 firefighter positions that were funded by SAFER and through the team working through and saying we don't want to lose any positions that are there. What are we going to do to maintain those positions that are in there, which goes to that service delivery. And then I think the thing that Amanda said that we've really talked a lot about is that the things that it doesn't reflect. And as you said, is that we know that we have some opportunities, hopefully for a SAFER, or not for a SAFER grant, but for an SCBA grant, but we know that there will be a significant match that will be coming up on that there. We have some settlements that are coming up that will have a portion that we'll deal with. The IGT and some of the future, really looking at that, probably the way it should have been looked at is, hey, we have the money today, but don't make a long-term plan on that and use it wisely as we go forward. The estimates have been on as far as the pension obligations. In 16-17, it was 24.8. The estimates was that it was going to go to 27 million, and then 18-19, 32 million, and it has been right online, and there's nothing that we can look at those and not expect those to happen as we keep on moving forward. I think as we did with Chief Shannon went through and looked at apparatus and put together a plan for how do we become a replacement and we become consistent in that we can change that replacement, but if we change it, we know what's going on or what we're not buying. I hope that the station assessment becomes very similar to that. We have some very nice new fire stations that are in good condition, but we also know we have a number of them that we haven't put any money into for a while. And I think what will be nice about this is that we'll have a snapshot of, okay, in 18, this is the way the district looks. And now we have an option to make choices as we move forward then. So again, Amanda, thank you and your team for putting that together, and thank you all for your support.
Anything else? All right, then, our next meeting will be September 27th. Any anticipated agenda items, please forward them to Ms. Pania. And we will adjourn this meeting at this moment. Thank you for coming, gentlemen.